Okay, so if you've been watching the stock market lately, you've probably seen the roller coaster ride. Maybe even been scratching your head a bit.
It's definitely been eventful.
Right. So today, we're going to zero in on something pretty specific and honestly pretty huge. That massive 9.5% jump the S&P 500 took back on Wednesday, April 9th, 2025.
Yeah, and you shared a really interesting article from The Motley Fool published just after that on the 14th. The title was, "The Stock Market Just Had One of Its Best Days Ever. Here's What History Says Comes Next."
Exactly. So our mission today is to, dig into that, understand what happened, get the context, and see what history, at least according to this article, might tell us about what could happen next.
Sounds good. Let's unpack it.
Okay, first off, 9.5% in one day for the S&P 500.
That's
massive, right? It covers so much of the U.S. economy.
It's huge, not something you see every day or even every year.
And the article points out this wasn't just a good day. It was actually the third largest single-day percentage gain since the S&P 500 index started way back in 1957.
Third largest. That really puts it into perspective. It's in very rare company.
So what was the trigger? The article mentioned the Trump administration. Something about tariffs.
Yeah, that seems to be the main catalyst cited. They apparently backed down from pushing aggressive tariffs on, well, most countries.
Oh, okay.
Big exception, though, China. Tariffs stayed really high there, 145% according to the piece. But easing off elsewhere seemed to be the good news the market wanted.
You'd think, okay, 9.5% jump, maybe things are finally calming down. But the article kind of pumps the brakes on that idea pretty quickly.
It does. It mentions the market actually fell the very next day.
Right. And then only a small gain on Friday.
Which tells you there was still a lot of nervousness, a lot of volatility lingering around.
Yeah, skittish is a good word for it.
And this leads straight into a really crucial point the article makes, this idea of bear market rallies.
Bear market rallies. Okay, explain that a bit.
Well, the observation is, and this is pretty counterintuitive, some of the absolute biggest up days in stock market history have actually happened during bear markets.
Wait, really? Not when things are generally going well.
Exactly. The article specifically points out that if you look at the top 10 best single days for the S&P 500, they happened in years like 1987, 2008, and 2020.
Okay, I remember those years. Not exactly smooth sailing.
Not at all. The article calls them years with vicious bear markets.
Wow. So why? Why do you get these huge spikes down in the middle of a downturn? Is it just wild swings both ways?
That's part of it, the heightened volatility. But the article suggests it's often linked to how bear markets unfold. You start with, fear, negative news, like those tariff threats initially.
Okay.
That leads to a lot of selling, sometimes panic selling, and also short selling increases people betting the market will fall further.
Right, short sellers.
So when you have this really negative sentiment and everyone's positioned for more declines, any little bit of unexpected good news.
Like a tariff pullback.
Exactly. It can cause a scramble. Short sellers need to buy back shares to close their positions, preventing further losses if the market keeps rising. This buying pressure adds fuel to the fire.
Ah, so it forces the bears to cover, which pushes prices up even faster, like a coiled spring releasing.
That's a good way to think about it, a sharp reversal. The article talks about heavy repositioning of portfolios as sentiment swings. You saw similar things during the 2008 crisis, these massive relief rallies punctuating periods of intense fear.
Got it. And the article also mentioned that at the time it was written, the S&P 500 wasn't technically in a bear market yet.
Right. The standard definition is usually a 20% drop from a recent high.
But it was close.
Very close, according to the piece, which kind of reinforces the point this huge gain happened in the context of significant weakness, not strength.
That proximity definitely seems important. It wasn't like a healthy market just decided to leap higher.
No, it felt more like a reaction within an unstable environment.
And speaking of unstable, that ties into the volatility index, the VIX, right? The article said it was way up in 2025.
Yeah, up 150% year-to-date at that point. That's a huge jump in expected volatility.
So that VIX number tells us investors were basically expecting big swings.
Precisely. It reflects that anxiety. The article describes it as violent upswings combined with big down days. That's sort of the signature of a nervous market.
Okay, so big up days can happen in down markets. The article also touched on how long these downturns typically last. What was the average?
It mentioned the average bear market lasts a little less than a year.
A little less than a year, okay.
And given that the pullback they were discussing had only started about a month before the article came out?
The implication being it might have had further to run, historically speaking.
That seems to be the suggestion based on averages, but
Okay.
it's crucial to remember that's just an average.
Right. Averages can hide a lot of variation. Some are shorter, some drag on longer.
Absolutely. Some crashes are quick and brutal, others are a slow grind down. The main point wasn't to predict the exact length, but to caution against seeing one good day as proof the whole downturn is over, especially when it's historically early.
Makes sense. Don't pop the champagne just yet based on one day, even a record breaker.
Exactly. Now, the article then shifts a bit to talk about how investors, how we tend to react during these times.
The psychology part. What did it say?
It highlighted a tendency for many people to actually trade more often during bear markets.
Really? More often. Why?
Well, the thinking might be, things are moving fast. Maybe I can jump in low, sell on these rallies, try to time the swings.
The urge to do something when everything feels chaotic.
Precisely. But the article suggests this often backfires. More trading, driven by emotion, fear, greed, trying to catch the bottom or the top can lead to poor decisions.
Okay, so trying to day trade your way through a bear market rally is probably not the best idea for most people.
Generally not advised, according to this perspective.
So what's the alternative approach the article pushes for?
It really hammers home the importance of a long-term view. Sticking with your plan.
Staying the course.
Yes, staying the course is one phrase they use. And also dollar cost averaging for those who can.
Right, investing a fixed amount regularly no matter what the market's doing.
Exactly. Buying consistently means you automatically buy more shares when prices are low and fewer when they're high. But, and this is a key qualifier in the article,
Yeah.
this strategy makes the most sense if your financial house is in order. High interest debt paid off, emergency funds stocked up.
And you don't need that investment money for, the next few years at least.
Crucially, yes, you need the time horizon to ride out the potential volatility.
That makes total sense. And did the article mention any advantages individual investors might have here?
It did touch on that. Unlike big fund managers who might face pressure for short-term results or have strict rules.
We as individuals have more flexibility.
Potentially, yes. We can often keep adding money steadily. Maybe even increase contributions when prices look attractive, buying quality companies potentially on sale, less pressure to time things perfectly day to day.
So taking advantage of the downturn rather than panicking about it.
If you have that long-term perspective and the financial stability, yes.
It's interesting, though, the article basically says the best investment decisions are often made during bear markets. That feels wrong somehow, doesn't it? Goes against the gut.
It really does. Your gut screams, get out, or wait till things are safe.
Right.
But the logic is that downturns are when assets become potentially undervalued.
Yeah.
That's when patience and discipline can really pay off over the long run.
Assuming you're buying quality assets, of course.
Of course, it's not about buying just anything that's fallen, but yes, acquiring solid investments at lower prices. The article specifically warns against trying to foolishly day trade around bear market rallies.
Okay, so let's try to wrap this up. The big takeaway seems to be that amazing 9.5% gain, while definitely eye-catching.
Historically speaking, it looks more like a feature of a volatile, uncertain market, maybe even a bear market, rather than a clear, all-clear signal.
It's a characteristic of the problem, not necessarily the solution yet.
That's a good way to put it. The article really leans on history, suggesting these huge jumps happen amid broader trouble.
So the core advice remains pretty consistent, doesn't it?
It does. The article concludes by stressing consistency. Sticking to your plan, focusing long-term, avoiding emotional trading based on these wild swings. That's generally the path to long-term returns, despite the current worries.
Right. So for everyone listening, wrestling with what these market gyrations mean for you, this deep dive suggests keeping your eyes on the horizon.
Focus on those long-term principles. And maybe even see volatility not just as risk, but potentially as opportunity if your timeline and financial situation allow for it.
Yeah, that perspective shift is key.
And maybe that leaves us with a final thought for you, the listener, to sort of mull over. Given this historical pattern, these big, exciting up days often happening within wider downturns, does that change how you think about reacting to market news? What adjustments, if any, might be worth considering for your own long-term strategy during periods like this?
Not about making impulsive changes, but about thinking critically about your approach in light of this historical context.
Exactly. Just something to consider as you navigate your own financial journey.